Welcome to Just a Tip Tuesday, boys and girls. We got Gregory back in town.
Are we live today? It's a live show?
This is a live.
Oh.
It's not live.
It's not live.
We're
I thought
live.
It would have been nice. It's Tuesday.
A big drop in interest rates is also continuing today. Look at the 10-year yield, which is hovering near its lowest levels ever. Diana Olick is looking at the impact that's having on mortgage rates here and the housing market. Diana?
Can I ask you a question? After watching that video, does the stock market have a lot to do with what just happened with the bonds and the interest rates?
Yeah, 100%.
I know
So
that,
because of the sell-off in the stock market, people want to put their money somewhere where it's safe. So they buy bonds. So as the price of that bond goes up, the yield goes down. Direct relationship between the yield going down and interest rates.
So as the market goes up, rates would go up. Market goes down, rates would go down. Roughly?
It's really not so much about the market, because the market could go up based on something that doesn't actually affect.
But if the market
mortgage
creates some type of
the sell-off that's
scarcity,
happening,
if the market creates scarcity and like volatility, and people don't know what to do, so they pull their money out, they put it in bonds. When that drive the rates down, when the market's in that volatile state.
Correct. Yeah. So if the market is moving because of scarcity and people are looking where to put their money, which this could all
is it not scarcity right now with this
scarcity with coronavirus, the European Union and everything there. UK just had a hike in rates for the second time this decade, and yeah,
interest rates.
Yeah, we've seen overnight lending. So we've seen huge, the biggest day in the S.2 500 yesterday is in the last 2 years for a loss. NASDAQ down, everything was down, and yeah, there's a sell-off. And where do you put that money? Where's like the safest place? A lot of people think commodities. A lot of people think bonds. When you buy bonds, the value or the face value of that bond could go up, which would be like a premium over that bond value, and that would drive the yield or the interest rate that you're getting from that bond down, which drives rates down.
It was at over 4.5% just 1 year ago, and the expectation was that rates would move slowly higher this year. So let me do a little simple math for a borrower with good credit and a 20% down payment on a 30-year fixed. For a $300,000 loan a year ago at 4.6%, the monthly payment was $1,520. Today, it's $1,320, a savings of $200 a month. No surprise, the refinance market is suddenly booming. Applications to refi up around 165% compared with a year ago. But mortgage applications to purchase a home and home sales so far are not reacting as well. That is more due to the severe shortage of homes for sale.
Will the refi boom kill the housing market 5 and 10 years out because nobody's going to move? They're going to be locked into these homes with these low rates, and they're never going to leave. You know what they're going to do? They have another kid. They're going to build a room, but they're not going to move, and no one's moving.
I agree with them. I mean, there's been a shortage of inventory for a while now, and it's not necessarily, it's two-sided. One, the entry barriers are lower for FHA conventional first-time home buyers, 3% down, 3.5% down. That has been that way for maybe a year or two now, and you can get a home easier than you could years ago.
My question is this: do you think what he said about because rates being so low? I don't think really. It's more of an opinion, or it might be more suggesting it. If rates are so low and people are locking in, that no one's going to want to move and they'll build an extra room in their house. Do you think that's going to actually happen to be that impactful? Or do you think it's more like financial officers like he is, who are like super financially fiscal? Those people might, but that's like represents like 15 to 18% of the population that have mortgages.
Yeah, no, I don't think so, because when the supply is really low and the demand obviously increases, it increases the value of their home. So if they have a kid, instead of building a room, they're going to go, oh, my house is worth $600,000. Now I only paid $400 for it. They're going to sell it for $600,000. And if it was a higher interest rate and the house was worth $500,000, the cost to the borrower is the same.
I agree with that 100%. I don't think that's going to be the case where like no one's going to move because of rates. It's $200 more a month in his example, right? They used. But if you're going to go from, people are emotionally attached to real estate. So I have this house here, but I can get that house for just $200 more a month at my mortgage, or whatever it's going to be. If it's $300 more a month or $400, but you just made this on this house, you just made $300,000, $200,000 last 5 years. I'm buying that. Like it's emotionally attached, right? A lot of people make financial decisions based on emotion. It's not right, but they do. Real estate's like that. They picture their family and their kids and their spouse living in a particular home, and that's the connection to it. And I think that's why it'll never be the case where like no one will ever move, because their rate's so low. I think there's going to be a general population that do that, but nothing that's substantial.
Yeah, it almost makes it easier to like kind of move and shake. I think the part of the population he's talking about is the part that has a lot of equity or has been in the house for a long time, and they're concerned with trying to pay it off or get the lowest cost of borrowing. But your average family that isn't putting 20% down, that's getting a home, and that home appreciates in 6 months or a year or 2 years because of the demand, is still going to move and sell the home and move on.
From where you sit, how do you see this playing out? Yes, the lower price should make the monthly payments better on a mortgage, but if you don't have the 20% down, there's no getting around it, is there? I mean, is there a way through the non-banks, through non-traditional channels for the millennials, for others who feel like they're shut out of homeownership to take advantage of these low rates, or is that hurdle, that 20% down payment hurdle, just going to remain?
Well, look, you have FHA, which is 3.5 down on a monthly for the mortgage. So there are a lot of ways to get into the mortgage market right now. It's a question of, do you have the credit? Do you have the ability to repay, which is a big part of the market today?
So if you're a first-time home buyer, the answer is you're not getting priced on the market. But as far as supply and demand in housing, that's a whole different question, depending on where you live. I think it's different everywhere, right?
Yeah, they just want to establish an ability to repay. 2 years of any type of income consistently is acceptable. Yeah. You could literally, be a photographer, be whatever. If you have 2 years of income.
It's actually good to have an environment where there's a shortage of homes and properties, not rentals, but it's good because it just drives more development, it drives the economy better.
And construction loans are extremely cheap and have been.
You want to see cranes everywhere you look.
Way cheaper than they've been in the past, construction loans. Yeah, I would say the general consensus is we're getting a ton of calls. Everybody's like, rates are going down. Rates are so low. There's still a lot of scarcity in the market. And when you have, everybody selling off and you have
bicep looks massive there, dude.
Huh?
You do curls today? Your bicep, is it just a tighter shirt? That's huge.
It's been working out.
My quad and your arm. Yeah. Are you just doing steroids just in your biceps?
Scarcity of the market. Sorry. You have scarcity of the market.
Distracted.
Everybody thinks that you are like, these rates are going to be so low. When rates are as low as they are, this morning rates ticked up a little bit, just as an example.
Ticked up?
Rates
what does that mean, ticked up
just a bit. So the flip side of that is that eventually it could go lower, right?
There's your Tip Tuesday.
Just the tip.
Everybody have a super week. We'll be back again.
We're getting nachos for lunch.
Nacho Libra.
Nacho with vegan cheese and potato.
What?
Just kidding.
Can you say gnocchi for me one more time?
Gnocchi.
Gnocchi.
It's delicious. We should go. We have Andreas.
Yes, it is very good. Just a little plug for the one person who's watching. All right.
How many viewers do we have?
104 subscribers.
Wow.
Okay.
Thank you, guys.
All right, Thomas, thank you very much. We're going to be signing off here for the Tip Tuesday. Shop your own mortgage. Have a great week, everybody. Bye-bye.